Welcome to another episode of Alpha Call, where we cut through earnings noise and get to the real story behind India's listed companies. And in this episode, it's not just one company. Yes, Zomato versus Swiggy. The Indian food delivery wars just got tastier. So, who's winning the war for India's plate? Let's try to find out. Let's start with the scoreboard for the quarter ending September 2025. It is Q2 of fiscal year 26. Zomato, or Eternal as it's now branded for investor disclosures, posted strong sequential growth. Its food delivery business grew 14% year over year with an adjusted EBITDA margin of 5.3% of NOV. That's net order value. And that translates to over 500 crores in adjusted EBITDA this quarter compared to about 450 crores in Q1. But the real energy and investor curiosity was around Blinkit, quick commerce vertical. Blinkit's net order value, or NOV, jumped a staggering 137% year on year and 27% quarter on quarter, driven by store expansion to now 1,816 locations. EBITDA losses there are shrinking. The margin improved to negative 1.3% versus negative 1.8% in Q1. Swiggy, meanwhile, reported a platform GOV, that's gross order value, of 16,683 crores. Its food delivery GOV, or gross order value, came in at 8,542 crores, and for the first time, EBITDA margin hit 2.8% of GOV, up 125 basis points year on year. In short, core food delivery business is now solidly profitable. And over at Instamart, Swiggy's quick commerce arm, GOV grew 108% year over year to 7,022 crores. Contribution margins improved by roughly 200 basis points, now at negative 2.6%. Their average order value, 697 rupees, tells you customers are building baskets, not just buying bananas. So, both companies are expanding fast, but the direction of travel is a little different. Zomato is doubling down on scale first, while Swiggy is chasing unit economics. So, what's the road they have taken? Let's talk about what management actually said in the earnings calls, because that's where the alpha call lives. Zomato, Dipinder Goyal was clear. Blinkit is still in expansion mode. They're not optimizing for near-term profitability, they are optimizing for presence. He said several city clusters are already EBITDA positive at over 3%, but as long as the lifetime value to CAC ratio holds, they'll keep spending. CAC stands for customer acquisition cost. They have raised their store target to 2,100 by December 2025 and plan to cross 3,000 stores by fiscal year 27. Now that's a full-blown physical infrastructure push because, let's face it, Q-commerce is a real estate game dressed up as an app. Now, the interesting shift happening under the hood is Blinkit's transition to a 1P inventory model. That means Blinkit buys and holds inventory instead of acting as a marketplace. The CFO said this change improved gross profit by around 300 basis points of net order value in the second quarter. But, and this is key, only about 1 percentage point of that will flow through to the net margin over the next 4 to 6 quarters because warehousing and logistics costs move in-house. So, you will see margin improvement, but gradually. And over at Swiggy, the story is slightly different. They are already balancing growth and profitability. Instamart's footprint of 1,102 dark stores across 128 cities is smaller than Blinkit's, but the economics are moving in the right direction. They have expanded aggressively outside metros and still managed to improve contribution margin to negative 2.6% and cut the adjusted EBITDA loss to 849 crores. The team mentioned strong operating leverage, meaning each new order costs them less to serve than before. And on the food delivery side, Swiggy's adjusted EBITDA margin has now hit 2.8%, up from 1.5% last year. So while Blinkit is sprinting to build scale, Instamart is jogging towards profitability, and both are surprisingly pacing well. Now let's try to decode what analysts really pushed for in the Q&A. For Zomato, the recurring question was, when will Blinkit turn profitable? And the management's response was, quote unquote, not yet. They are comfortable letting marketing spend rise as long as unit economics remain positive. In fact, marketing was up 1.4 times quarter on quarter and over 4 times higher than last year. It sounds aggressive, but they argue the CAC payback is healthy because repeat purchase frequency is growing. Analysts also asked whether Blinkit's 1P shift will hurt working capital. The CFO clarified that the model change actually stabilizes fulfillment and gives better control over assortment. So while capital intensity rises a bit, gross margins expand faster. Essentially, they are trading some balance sheet flexibility for pricing power. And over at Swiggy, analysts were laser focused on two things: Instamart losses and cash burn. And the management's message was that burn is trending lower. Their platform wide adjusted EBITDA loss fell to 695 crores, down from 813 crores the previous quarter. And they're guiding that both Instamart and core food delivery could together push Swiggy towards overall EBITDA breakeven sometimes in fiscal year 27. And one sharp analyst from Morgan Stanley asked why Swiggy's realizations were holding up despite industry wide price cuts. And the CFO's reply was candid: better mix. So, more premium users, bigger baskets, and higher cross category participation from grocery and breakfast slots. Basically, they are selling more value, not more discounts. Let's quickly do a comparison head to head metrics, sort of. So, as you can see, on most metrics, they are in the same ballpark. But on narrative, they couldn't be more different. Zomato talks like a venture funded growth company inside a listed wrapper, while Swiggy talks like a maturing private company readying itself for IPO discipline. And reading between the lines, here is what I find fascinating. Both firms are essentially pivoting towards cash flow credibility, but from opposite ends. Zomato's advantage is structural. It has the public market currency, improving profitability in food delivery, and a first mover advantage in building the Blinkit brand. Its decision to invest heavily into a 1P model shows confidence in operational control. The downside, yes, working capital intensity and the risk that margin gains get delayed if cost inflation returns. Swiggy's edge is operational. They have shown they can expand quick commerce volumes without blowing up losses. Instamart's AOV, or average order value, of 697 rupees and 200 basis point margin improvement show customers are sticky and profitable behaviors are emerging. Both are, however, benefiting from one macro tailwind: the normalization of food inflation. Stable input costs mean they can focus on logistics efficiency and not just pricing. So, what about the outlook and what's next for them? For Zomato, all eyes are on Blinkit's operating leverage. If margins turn positive by fiscal year 27, even modestly, the market will reward the stock with a higher multiple. And management has already guided that steady state margins can be 8 to 10% at the platform level once scale normalizes. But they will need to prove they can manage over 2,000 stores profitably. And for Swiggy, the milestone is simpler: group level EBITDA breakeven. They have hinted at it happening between fiscal year 27 and fiscal year 28. In other words, Zomato is playing offensive, Swiggy is mastering defense. And in the long run, both sides may win because India's food delivery market is large enough for two players, but disciplined enough now to punish the reckless. So here's the alpha call insight. Zomato's Blinkit is scaling like a tech company, heavy on marketing, high on conviction, while Swiggy's Instamart is scaling like an operator, quietly improving efficiency each quarter. The next 6 months will decide who cracks profitable convenience first. Because at this stage, it's not about who delivers faster, it's about who compounds smarter. This is Radhakrishnan Chonat, and you've been listening to Alpha Call, where we go beyond the ticker, beyond the delivery boy, and deep into the delivery business. Thanks for listening. Until next time.